Hi, this is Pete Birchler of StockMarketAlchemy.com. It's Monday, March 11th, and I'm going to do a brief overview of the stock market here on a few different time frames and give an opinion on where we're at and where I think we're going. First off on this chart, this is the S&P 500 tracking ETF, SPY, and currently prices have touched above the upper Bollinger Band 5 days in a row. And the bands have been expanding for 6 days in a row, so moving away from each other. So when bands are expanding, that's an increase in the volatile move, and those will typically precede a significant higher low in a market. And looking at some prior periods of expansion over the last few years, a lot of times in that 5 to 7 day range, when you start seeing the bands expanding for that long, you're getting pretty close to at least a short-term reaction point. What we may expect here is for the market to experience a correction for a few days, possibly followed by a move to higher highs. But I think that once we do see that type of action, we're probably pretty close to the ending phase of this leg up. Based on projections of standard legs up, as we move towards the end of this month, we will be getting into a time frame where some projections for this leg up would be ending, and the median time for a leg up in the S&P 500 historically has been about 4.5 months. So as we get into April, we'll start to exceed that time frame. So the next few weeks here, if we don't see a top and we move beyond that, we would certainly be getting to a time frame where the leg up would be somewhat extended. Now I'm going to move to a chart of the Russell 2000 Index ETF, IWM, for a minute, and this is showing a MACD indicator down here with a period of continuing divergence. It's somewhat of an odd, not really a classic divergence here in that we have a few crosses, but in any case we are still currently showing some divergence relative to the prior momentum peaks. So we may want to use a simple trend line or something to that effect as far as trying to gauge when prices have actually cracked this uptrend. Now, on an hourly chart of the S&P 500, what I want to note here is anytime we're getting into a kind of quote-unquote overbought scenario on a longer-term time frame, is we want to move to a shorter-term time frame, and then we want to look for divergences to show up on a shorter-term time frame. So since the recent low on February 26th, after this brief correction here, prices have pushed higher, and now we're seeing prices push higher over the last week or so. However, the MACD is currently not at a higher high, and what we might be looking for here is some type of exhaustion type of move. If we see a significant gap up at any point over the next couple of days, we could look to be a seller of that gap up, and there are certain triggers and entry patterns we can look for. But in any case, once we have this divergence show up, we want to be possibly looking for opportunities to trade contrary to the trend of the market. So if we do see stocks move a little bit higher and then we see this MACD cross down, we could use that as a potential sell signal. As far as nearby support, we have this gap up from March 5th, and that is unfilled, so that may be a first initial target. If we do see a market experience divergence and then turn down, we could probably target that gap, or at least use that for partial profits. And then we have several unfilled gaps here below the market back towards the January where we saw this gap up around New Year's time frame. So we could see the market move down and fill some of those gaps on an intermediate decline as well. Now, the Nasdaq 100 is continuing to develop into a possible head and shoulders topping pattern. I'm going to talk about this here for just a few minutes. First off, the pattern off of this right shoulder appears to be a rising wedge type of pattern. If we draw some trend lines in there, so we have contracting trend lines as the pattern is moving up towards its highs here. And additionally, when we do see a rising wedge pattern like this, oftentimes the end of the pattern, so the highest point in a wedge like this, will oftentimes touch or exceed this upper boundary line. Now, question on where to draw that. If we drew that strictly containing all of the price action, we could draw it there. If we brought that down to create 3 touch points between here, here, and here, that would be slightly lower. But in any case, it looks like we may experience a little bit higher highs here over the next day or two. But if we do see it hit that trend line and then create a reversal type of a candlestick, then that could be an initial indication we may be seeing some reversal, and we could monitor that and see if any larger time frame sell signals develop coming off of that high. One more time frame we'll look at here. Let's look at a weekly chart of the S&P 500, and this shows a couple different time frames of stochastics. One is a 7 period, one is a 21 period. Both at this current time frame are showing some divergence here on this push to new highs above the February highs. So that could quickly be erased if we see higher highs into next week. But if we do see the market top out here this week, or possibly early next week, we may see these divergences hold, and that would be an indication of a more typical type of pattern that we see as a high is completed, where we have a high in the indicator, a brief correction, then a push to higher highs in price, but a lower high in the indicator. That's what we typically see preceding significant corrections in the market. So that would be another thing to look for on a weekly time frame. Now, what I want to spend a few minutes on is some commitment of traders data. And again, for those who don't follow this regularly, the commitment of traders is a report issued by the Commodity Futures Trading Commission, which basically gives us positions for the largest traders in the futures market. And it does that for all the actively traded futures markets. And what I've done here is sorry about that, we have an alert coming off there. But what we have here is we have a composite that I've created of the S&P 500 futures, the Dow futures, and the Nasdaq 100 futures. And what this chart here is showing is the net position of the smart money, so to speak, so the commercial traders. Basically, the report breaks it down into 3 groups: the commercials, the non-commercials, who would be called the large speculators, and then the non-reporting positions, which are typically called the small speculators. So this chart shows what are typically referred to as the smart money traders, which are the commercial traders. These would be the large funds and pensions and mutual funds and things who are using the futures market to hedge their underlying stock share position. And what we've seen is they are currently at a relatively extreme net short position, close to the recent multi-year extremes they've put in this fall and winter. And what we've seen is on the breakout and push to higher highs over the last couple of weeks, they've actually been sellers, and relatively sharp sellers, into that over the last couple of reporting periods. So we have some indication that the smart money is acting contrary or selling heavily into this push higher in stocks. That's coupled with some technical divergence. So we certainly have some confirmation from this data that we could be anticipating a high for this current leg up. Now I'm going to move up and show just a couple more charts here of this data. As soon as there we go, price will allow it here. Okay, so the charts I want to show, one is a COT index chart, and so this shows basically where the current COT net short or long position is relative to its range over the last couple years. And we've seen it move down from a neutral reading closer to an extreme net short reading over the last couple of reporting periods. It is not at a real extreme reading yet, but sometimes especially if we're looking at a possible head and shoulders topping pattern, whereas you can kind of see that on an inverse basis here. You can kind of see while stocks are making a head and shoulders pattern, this data is making possibly a inverted head and shoulders pattern. So an extreme reading in April to May of 2012, a very extreme reading in September of 2012, and now a slightly less extreme reading again. So we may be seeing a somewhat typical pattern here And given the fact that the Dow and the S&P and the Russell are all at higher price highs here, yet this index is not at an extreme reading, there is some divergence developing, and that is not uncommon as price reaches their final high is for a divergence pattern to develop. So again, added confirmation there from the COT index that we may be experiencing an end to either a leg up or possibly even a bull market with this extensive divergence occurring right there. Now, this next chart is showing a COT movement, so it's showing how fast their positions are changing over the last 6 weeks. And the current price bar shows that they've made a relatively significant and rapid change in their position towards the short side over the last 6 weeks, and that corresponds with where some of the recent, at least short-term price peaks have happened prior to corrections over the last couple years here. So it is not at a very extreme level like we've seen happen a few times over the past couple years, but it is at an area corresponding to where we've seen some corrections take place over the last 1 to 2 years. And one more indicator I'll show here is what I call a COT spike indicator, and it's somewhat similar to the one I just showed, but it's showing how quickly or how rapidly the commercial traders are changing their buying or selling. And what we'll do here is we'll zoom in on this chart a little bit. And so what it's showing here is that this current reading as of the current reporting period is one of the lowest readings it's shown in the last couple years. The prior low readings in the indicator were December 18th of 2012, which was followed up by a 1.5 week sharp correction, and then we saw in May of 2012 and in July, and from the end of July to September of 2012 we saw some low readings. That preceded the correction from September to November. This reading here was May 1st of 2012, which preceded the correction into the June 4th low, and then on into 2011 at the July price peak, and at the April to May price peak we also saw some extreme readings like that. So anytime we see this line right here getting down towards this white line right here, we're beginning to see some extreme readings. So again, we have some added confirmation that the smart money traders are selling somewhat rapidly, and I combine a few different measures of the rate of selling into this indicator. So in any case, we have some very significant, I believe, confirmation from the COT data that we are probably close to a price high for this leg up, and we are also getting into the typical median time frames for a leg up to end. And we have significant signs of technical divergence across several different levels here. So that is primarily what I wanted to cover for this update here. I think that if you go through and compare the U.S. markets to some foreign markets, some of the foreign markets look significantly weaker. So depending on if you're U.S. or non-U.S., you may want to consider, if you're looking to go short or inverse to the markets, possibly look at some foreign ETFs, some that appear to be the weaklings or the laggards as far as the stock indexes go. So that's all for this update. As we hopefully get some signs that the market is confirming a high here, a tradable high over the next few weeks, then I will probably update again here. But these ending periods of legs up can be relatively choppy, and they may take a few weeks to play out. We've already been kind of seeing that over the last couple weeks. So once we start to get some confirmation of a significant indicator development or price breakdown, I'll update again on the blog here. So that's all for today. Have a great day. All the best to your trading.